So let's shift over. So should you never buy term? No, not at all. So the way I like to approach it when we talk to our planning clients, when we get to that insurance conversation, because you want to protect your assets, right? You want to protect your family, you want to protect your income. You can tie in some long-term care stuff into that too. And I'm not talking standalone long-term care. That stuff's expensive. I'm talking like riders and things like that. But having a foundation of insurance with the permanent insurances, okay? There's UL, there's index UL, there's whole life, there's several different, types of what I call permanent insurance. Some are good, some are great, some are which we'll dig into in just a little bit, but you use that as your foundation, okay? And you're not really using it for the insurance piece. Let me say that again. You're not really using permanent insurance for the insurance piece. You're using it to build wealth, another stream of wealth for you when you get later in life, another stream of income during your retirement years, right? There's a whole bunch of benefits to it. You don't know what we're talking about, reach out to us. We'll sit down and walk you through what it could do for you. And we'll do that totally free, right? But going back to my statement, you have that foundation of permanent insurance, whatever the need may be. Now, that doesn't mean you're going to go out and have just permanent insurance. And I see a lot of insurance salespeople out there that, they set their clients up these big fat policies with a lot of coverage in there. And it's used, it's all permanent insurance, not really designed for any cash growth or anything like that. And they're paying way too much for it because they're not going to need all that insurance down the road. When the kids are gone, house is paid off, bills are paid off, your dime number goes down. Mm-hmm. This is why you have a foundation of permanent, but you augment it. You put the roof on your house, so to speak, in term insurance. So once that term insurance goes away in 30 years, you've still got that foundation of permanent that's going to last you typically to age 120. You're not going to make it to 120. Maybe. I'm not going to say never. But that way you have something to pass on to your kids, your grandkids, and everything else, some kind of legacy. And by that point, once you go into retirement, you typically stop paying for it if it's set up properly. So that's where that permanent insurance can come in. So you have that foundation of permanent. And I know some of the gurus out there, all permanent insurance is horrible. They're wrong, just flat out wrong. And I'll explain the numbers. If you want to sit down and go through it with me, I'm more than happy to go through it with you. But going on a soapbox there, Wendy, what else do you have to add on that? What are the pros and cons of that permanent insurance?
Yeah, the pros, is that you can build that cash value, that you have that insurance to pass on, leave a legacy, cover, because guess what? You still have funeral expenses one day. And, I've lost all of my grandparents during my lifetime and none of them had insurance. So their kids, and none of them really had wealth either. So all their kids paid for their funeral costs. And so it covers that. I think the legacy planning is huge. Not to get all into this today, but I've been fascinated by, we read that book with our book club, What Would the Rockefellers Do? And how to leverage insurance to create generational wealth, which is so interesting. But yeah, the cash value piece, which you said, you made a key statement, if it's written properly, because we see people with those permanent policies that are written the wrong way. And the gurus, like you said, the reason they bash them is because they're like, oh, they're really expensive. They cost so much, but it's those policies that are written the wrong way.
Well, and that's exactly right. I'm working with a client right now. They're getting two, one with our company, one with another company. She said, "Would you mind looking at the other company?" And I went through it, and I'm just like, that was written for a commission. Mm-hmm. And so, sat down, explained everything to the client, and the light bulbs went off. It's all about the education, right? But again, having that foundation, now you go into, the permanent insurance. Okay, let's talk about just that. So, you're not doing just group life, have it as gravy on top, right? You're not doing just term, have that to cover your big expenses in your younger years. And then, that goes away. So that cost goes away. You don't need to renew it and pay outrageous prices for it because you still will need protection in your 60s and 70s, guys. Trust me on this. I'm not quite to that age yet, but I talked to enough clients. Then lastly is that permanent insurance. Okay, well, what do I have? How much do I need? Well, that's going to depend a lot on, number one, your dime formula. Number two, what are you using it for? Again, don't necessarily want to have a big fat, permanent insurance coverage and a little bit of term, kind of 50-50 or 60-70 or 60-40, whatever the case may be, but it's going to be different for everybody. That's the thing. There is no silver bullet, but you look at, what's this cash value all about? Well, those permanent policies actually grow cash inside. They've got mechanisms on how they grow, things like that. Well, they cost too much. Not really. If you look at the big face value of what does it cost, and we did a video on value versus cost. Go back and watch that, and all of a sudden the light bulbs hopefully will go off for you too. But if you look at the whole strategy, and there are a lot of people out there, and you hear the term infinite banking, and that's just a sexy way to sell insurance, right? And the whole life strategy is a fixed rate of return. Okay, is a fixed rate of return. Who determines that fixed rate? Well, not your bank, and we all know that banks don't really pay. Look at your savings account, right? But you look at the companies, and these are usually mutual companies, insurance companies, right, that pay a dividend. And if you look historically, and you can go out on the internet and just Google historical whole life dividend rates, what do these companies pay out? And it'll list top 5, top 10. Over the last 20, 25 years, they've constantly just gone down.
Yeah.
And now we're hovering around 4 to 5%. Some are higher, some are lower, but on average around that 4 to 5% range. Okay, so my money's guaranteed to grow every year about 4 or 5%. Okay, call your local credit union and ask what their CDs perform at.